Okay. Welcome, everyone who will ultimately be watching this. Thank you for joining this evening. This is for Understanding Section 181, Tax Benefits for Film Investors. I'm going to be walking through a very quick kind of like overview of what it is. And let me go ahead and share my screen. Okay. And here we go. All right. So what is Section 181? Section 181, that's kind of like our shorthand. And what that refers to, it is the Section 181 of the U.S. Internal Revenue Code. It's more specifically what it allows investors to deduct up to 100% of their investment against taxable income in the year the money is spent. Now, I'm going to go into a little bit more detail in a few minutes of exactly what that means, because there are some restrictions on that, but I think I'm going to save that to a little bit further into the presentation as to what exactly that entails. What this incentive and the reason why the US government decided to enact this incentive was to encourage domestic film and television production. That's the purpose of it. And it does so by helping to offset some of the risk of investing in film and television projects in the US. An investor can have the benefit of the deduction, unlike some other tax incentives that are out there. An investor can have the benefit of the deduction and still get returns from the investment. Okay, so what qualifies? A production must be primarily US based. 75% of the costs um, have to be spent in the US. The budget must be under $15 million. Now, the rules have changed a little bit on this one. The budget can be more than $15 million, but only up to $15 million will apply, and 20 million if you happen to be doing production in what is considered an economically distressed area. It isn't the whatever the production is has to be intended for distribution. That's one of the tests that the IRS will put on there. It has to be, but they have a very generous definition of what is considered distribution. If you put it on your website for sale, that is distribution. Obviously, if it goes streaming, if it goes to um, theatrical, if you put it out in the theaters, or obviously if it's on TV, though, that would be considered distribution. Um, a proper election must be made on the tax returns. The election has to be made by the production entity that's claiming this tax deduction. We'll get into that a little bit more. And the investment must be at risk. Now, the good news is this is an entertainment project, so I think we got the risk part covered. Anybody who knows anything about investing in entertainment, yes, there is definitely risk. Okay, so um, second. Oh, this is not, my slide is not advancing. Second. Ah, got it. Okay. So how does this work? So a U.S. production entity makes the Section 181 election. This is what I had mentioned a second ago. The production company itself must make that election. That production company has to be structured as a pass-through entity because it's the production company that claims it, but then it can pass on that tax deduction if it's a pass-through entity. So, for instance, if you are a C corporation and if the production entity was a C corporation and it decided to claim that deduction, then only the C corporation could use it. It could not pass it on to other investors because there's a legal difference between the corporation and its investors. Um, so it has to be a U.S. production entity. it passes that deduction along through a pass through like an LLC or a partnership, and each member or partner deducts their share of that 181 tax credit against passive income. Remember, I said I was going to double back. That is one of the restrictions. It does have to be against passive income. It's not all income. Now, interestingly enough, I did find, which I did not know, there is I won't call it a loophole, but there is another flavor of this. If the individual actually participates, the investor actually participates in the making of that project, then and they contribute 500 hours or more, then I get, and we won't get into the details of like how do you prove 500 hours or more, but if that is the case, then that person, investor in that scenario would actually be able to deduct it against any kind of income, not just passive income. But for most of the case, it's going to be against passive income. Okay. That is one major restriction that should be aware of. So what qualifies? As we said, production must be primarily US based, and 75% of the cost must be spent in the US. The budget must be 15 million. Went over that before. It doesn't have to be, but only up to 15 million is going to apply. Intended for distribution. Proper election must be made on returns, and investment must be at risk. Okay, so what do you look for um, if you're looking for this type of work? Well, of course, first and foremost, proper legal structure of the production entity. Because if the entity is not structured correctly, if there's anything funky in the operating agreement, it's possible that something might be disallowed by the IRS. So you want to make sure that everything is in place and is well structured. Um, you want to make sure that for that production, there is a formal election. So that should be part of the documented records of the election that was sent to the IRS. Timing of the production. As some of you may know, the Section 181 has been around for a while, and it's been renewed several times. It's scheduled to sunset this year, at the end of this year. So, and of course, times being what they are, there is no we're not sure if it's going to be renewed or not. So you have to go by what currently exists. And if you want to get in under the existing law, principal photography has to start before the end of this year, before December 31st, in order to qualify for this deduction. So that's what I mean by timing of production. It has to be a qualified production type. We went over that in terms of the budget amounts and location. Yeah, it's got to be in the US. Investor participation level, meaning that there has to be an ownership interest with the people in order for that deduction to pass on to them. And that's why the pass-through entity still works. There has to be clear offering materials. And I got some notes here in terms of what we're talking about, clear offering materials. There should be a private placement memorandum, a breakdown of the Section 181 treatment, as in terms of if you have multiple members, who's entitled to the percentage, use of proceeds, any audit or accounting procedures, because again, everything's going to be looked at to make sure that the IRS agrees with you that this was a proper election to make, and if at all possible, a tax opinion letter. When you're making this investment, you want to have some sort of tax professional have had looked over it and said, yeah, we think that there is a high likelihood that this will, be approved by the IRS. Other things that you need to look at, a lot of people will say, what have you done? And the way I look at it is this way. I am more concerned because you're going to have a lot of, especially in the near future, you're going to have a lot of professionals that are up and coming. So I'm not concerned about the track record. You'll see a lot of people say, well, what's your track record? Or what have you done? I think the better question is, what is your plan? Because even if you have a track record, that doesn't mean your idea for this current project is one that might be considered viable. So I think that knowing what the plan, the overall plan is for the production, you want to make sure that they have, because just as with any entertainment project, the major risk to the investor is that it doesn't finish. You can't claim that tax deduction if it doesn't finish, because you'll never get to the point of distribution. And that, that's a key milestone in being able to claim this deduction. So making sure the production entity that you're dealing with has a viable plan. And if you're not an entertainment person, I realize, well, how do I know it's viable? You just want to make sure, that they've had some common sense, how many, if they can answer questions like, what's the shooting schedule going to be like? Where are you planning to shoot this? Um, just so that you have some sense that things have been thought through and that they're actually ready to, go ahead and make the thing that they say that they're going to make, and that you have confidence that they're going to be able to do it. And then, of course, last but not least, there should also be, like as I said before, a CPA review. You just want to include that. You want to see that, a tax professional has looked at this and said, yes, if all of these things occur, we believe it is likely that this deduction will be approved. Um, the other benefit to investing in this way is you can have an alignment of, financial and creative goals. It's an excellent way to support productions, that, like for us, we have a project that's coming up, Project Grace, and one of our things that we're very big into is creating opportunities for creatives of color, to have pathways to union memberships, both in front of the screen and behind the screen. So this kind of investment allows people, ways to encourage and support those types of projects, and whatever issue that you might have an affinity with. You can look for projects that you know match your particular area of interest. Okay, so how do you find these projects? Well, the key is like everything else. You're having a relationship with production companies. This is not something that, if you're not in this space on a regular basis, you would not necessarily have those connections. But anyone interested in possibly doing this, that's what I recommend, is developing those relationships. And you should get to know the production company, because like everything else, it strongly depends on who the staff is, and who's going to be working on it. So the CPAs that specialize, another another way that you can find these projects are through professionals like CPAs and attorneys, because especially those that work with this 181 tax incentives, because they normally deal with clients who would have a need for this, particularly clients with, large amounts of passive incomes that they might be looking to have some tax mitigation strategies with. So that's what I recommend. But like everything, it's you've got to put in a little bit of work just to, get to know these people. I wouldn't, invest willy-nilly in projects that you haven't at least had some familiarity with the company and the players in that company, who are going to be managing that project. And finally, I know this was kind of a quick little overview, but I have to do this, well, this legal disclaimer here. This presentation is for informational purposes only and does not constitute an offer to sell or solicitation of an offer to buy buy securities. Any such offer will be made pursuant to official offering documents provided to qualified investors. And individuals should consult with their tax advisors before making any investment decisions regarding Section 181 or other tax advantage um, opportunities. All right, so that's the legal stuff to get out of the way, and that's pretty much it. That's what I wanted to kind of go over, and I know some people, are familiar with it, and others are not. I will pause the presentation for the moment and open up, stop sharing. Uh, Well, I'll open it up to questions. And if anyone has any questions, I'll be trying to stop sharing my screen. Ah, I found the button. Phew. All right. Things have moved around a little bit. Sorry about that.
So that 100% deduction that's taken within the year, that
Yes,
is capped at that 15 million, correct? That,
correct.
okay,
Unless the production is shooting in what was deemed to be an economically distressed area,
stress area.
then
Okay.
it could be up to 20 million.
For that one, still at the 100%.
Yes,
Got
correct.
it. Okay.
It's a
Got it.
dollar for dollar, but against passive income. That's the
Yes.
that's the restriction.
Yes. Okay. Understood. Thank you.
Any other questions? And I see thank you, Richard, for joining us. I know this is
No, it was
stuff is
interesting. Yeah,
very familiar for you.
yeah. I saw an article how some people are abusing the Section 181 film credits there, not telling people that they have to have passive income to take the deduction, and selling it as like a tax shelter. And the
Right.
IRS has been cracking down on that. So
Yes, they
yeah,
have.
yes,
That's a good point. Yes, the IRS wants to make sure that this is an actual production. And that's why that intent for distribution is a key feature that they look for. And yes, I was doing my research, I came across the same thing
okay,
about
yeah,
people trying to abuse this as a tax structure, a tax shelter. And that's why I wanted to make sure in the presentation, because even myself, I had to, I was using the word taxable income, but that's not the right word.
right. It's
It's
the
against
deduction.
passive income.
It is passive. Yes,
Right.
it's
I mean, it is
passive.
taxable, but the key is that it has to be
Passive, right?
passive income. Yeah.
Yeah.
So
Yeah, and
I'm
then
glad we agree on that point.
yeah, no, good presentation. Yeah, and then a lot of with the different states, you have the tax credit programs there. So there are different ways you got to make sure you set up the structure the right way to get to try to get a lot of the tax credits that New York State is providing to the clients there.
And now with well, the other thing is the it's the production entity that actually gets this deduction.
Correct.
And that's why it needs to be structured as a pass-through entity. But that pass-through, of course, is going to be proportional to the particular investor's interest in that entity. So that's the other thing, the other test that the IRS is going to look at is,
Right.
well, how much of this thing did you get? And, what kind of, ownership interest do you have in that entity?
Correct. Correct.
So also a very important point, but it can be, especially for people who, you know, have unexpectedly large, tax bills because of passive income, and you happen to have an affinity for the arts. It's a nice way to, couple those two goals together, and hopefully promote, better art.
Right, correct. Yes, and hopefully that the federal government instead of making tariff on films being shot abroad,
Yeah.
broadens the federal tax credit there. not just
I
the deduction.
You touched on what I was going to ask as far as have you noticed, as far in the investor pool, that the administration's, the 100% Hollywood, tariff, um, conversation, has that spooked or minimized the investor pool or the production? Has production slowed down at all? Have you noticed that?
I That's a very difficult question for me to answer, not because I don't have a sense of what the answer is, but it's going to force me to admit something positive about this administration.
Okay, you're being recorded.
Yes, and I understand that this is being recorded. Um, I think that the jury is still out, but it we may actually back into. I've seen now more productions trying to bring it back to the US
Right,
and take advantage of things in the US, which is one of the reasons why I am hopeful that this section of the tax code will actually be renewed. Now,
right,
will it be renewed on time? I don't, I won't say it has never been. I can't, I don't remember every time that it was, but
Mhm.
when it wasn't, they almost always did it retroactively.
right. Correct.
So even if
Yeah.
they don't pass something in January of next year, whenever they get around to it, hopefully they'll make it retroactive and
Mhm.
people will still be able to take advantage of it.
Yes.
But I do think that in the short term, yes, I have seen more inquiries from production companies looking for space in the US to shoot things.
Okay. I just wanted to get a sense, but thank you so much.
Thank you.
I was trying to extend my reach because I know here I'm physically based in Texas. In
Okay.
Texas, um, a lot of studios are popping up all, just overnight, massive multi-million dollar studios.
Right.
Yes. Texas has one of the largest tax incentives
Hmm.
in the country. The problem is the cap that you have.
Yeah.
Um, and that's why it is not as competitive as Georgia or New York.
Right. Right.
And if California gets their act together, then California too will be but in terms of, I don't think anybody pays as much as Texas in terms of percentage of qualified expenses. I believe
Hmm.
it's 40%, which, wow, I mean, that's a nice number,
Hmm.
but the size of the program is the problem for Texas.
Correct.
But
Correct.
um, usually, unfortunately, there's also not to get into a philosophical discussion. There's usually an ideological bent, depending upon which party is in power, um, as to do they want to support the entertainment industry or not. But just forget politics, just from pure fiscal, sanity, for
Hmm.
every dollar in, incentive that they grant in that program, they get something like $6 back. I think that's what you know, the the statistics are. So this is one investment that makes sense to put money in.
Yes.
Because you're bringing in companies and individuals who are going to spend money in your state.
Hmm.
So it really does pay for itself.
Yes.
And that's why I saw like New York State expanded the credit. They realized how much people wouldn't be filming here in New York. New York is expensive, but if you try to
Right.
level the playing field there, people want to shoot here. And again,
Correct.
it helps all the ancillary services, the lumber yard, you know.
Yes.
Exactly. Now
Yeah.
if we can only get New York State to pay more quickly,
Oh, I forget that's a whole nother conversation.
that's the problem. That's
Yes,
why we're
yes,
losing to New Jersey is because
right.
New York takes forever
Yes,
but unlike the state tax incentive, so this section 181 is federal.
correct.
So that's a key distinction, that this is something that you would elect on your the production entity will elect on its federal return and then pass that through, to the member interest in that
Yeah.
entity, usually an LLC. or
Yeah.
Right. Right.
yeah. So, um, I think I think it's an important tool, and that I hope that they keep, going forward. And, because making content is not going to get any cheaper. That's for sure.
Right.
And I think that and one of the reasons why I'm doing this is because I want professionals like yourselves. So we have a lawyer and a CPA on the on this Zoom. I want to give you a chance to get to know me and my company. And I want to have regular dialogue with professionals like yourselves so that if an opportunity does arise, and I think that's what other filmmakers are going to have to start doing, is that you can't wait until you have a need. You've got to build that relationship before there is the need.
Correct. Or else you're going to miss it.
You're gonna miss, so
Yes.
and that's what and I know that we have one project, a short film that's in our pipeline, but it's a short film with a fairly substantial budget. And then we got two more projects planned. So that's why I'm trying now to build this network of people to say, hey, this is what we got going on. And if there's anybody who's interested, to learn more, obviously get in touch.
Yes.
Okay, great.
Fantastic.
All right. Any more questions?
No, you did a fantastic job, Gregory.
Well, thank you. Thank you both. What I'm going to do now is I'm going to stop the actual recording because I know, as I told Janice, there was one individual who wanted to be here. He's a financial advisor,
Okay.
requested that I record this. So, but I'm sure there'll be others that will look at this too. Uh, I'll just sign off now. Thanks for everybody for watching this. I
Okay.
hope,
Good seeing you again, Gregory. All right. Nice meeting you, Janice.
Nice meeting you,
Yeah.
Richard.
Yeah.
and I'm going to stop the
Okay.
recording here.